Richard Harris joining us, Chief Executive, Port Shelter Investment Management. Richard, thank you so much for speaking with us today. I mean, we're celebrating Diwali here. So the mood otherwise is good, but on the markets is looking a little tough. And I think some volatility on US markets as well, isn't it?
Well, first of all, very happy Diwali, and I'm sorry you have to work today, but I'm sure they'll give you some time off later. Yeah, I mean, the markets are looking sluggish, but you have to expect this ahead of the election. You know, the two candidates' policies are so different, and it's still so much a 50-50 guess that, you know, traders are going to find it difficult to do anything, to take any real positions. And I think that, you know, we're just going to be like this probably until right up to the day.
Richard, historically, we've seen that a reaction to the president or the new elected president is usually limited. Markets move on from the volatility and they go back to business sooner than later. In that case, would you use the current uncertainty to buy into equities in the US?
I think it's just too early. You know, we don't know. I think I'd be happy to stick where I am at the moment. You know, I still favor equities, but I certainly wouldn't be buying in the anticipation of one candidate or the other. They're both very different. And I think that people are quite mistaken on what they think candidates might do. You know, there's a feeling that Trump will be good for equities because he's going to lower corporate taxes. But what happens if you lower corporate taxes? You get more debt, interest rates go up. Interest rates are a killer for stock market. So I think the jury is still out on both candidates as what their declared policies are going to be and how that's actually going to affect the market. Now, my guess is probably we will see a bit of an uptick post-election, and then we'll come through into Christmas time. You know, we often have the Santa rally in December as people sort of level their books out. Next year, though, I think looks a lot tougher, but we really don't know until we know who's going to be president.
Richard, so would the election outcome be the chief determinant of what risk assets do in the near term? I mean, in the long term, we are all dead. Medium term, who knows? I'm talking about the short term.
No, and in the long term, India is a great story, isn't it?
Yeah. But EMs or India or what have you, is the US election the chief determinant, you reckon?
Well, it is. The problem is it's very, very difficult to forecast. You know, as I said a moment ago, you know, it's the old story is that, you know, there are bold investors where you can dive into the market now and take a bet, but it's just speculation. And there are old investors, but there are no bold, old investors. You know, I think at the moment to take a bet is really you're saying, I like Trump, I'm going to buy Trump stocks. Well, what if he doesn't get in? It's the same with Harris. And then, as I said a moment ago, we don't know if what the market's kind of thinking is going to be the policy of each candidate is actually going to play out in the market. So it's really very difficult. And that's why I think that at the moment we're seeing, you know, not bad results from the tech companies, but of course the markets haven't taken them maybe quite as well as you would have expected in a different market environment.
Richard, how important is the Fed's decision going to be? And what I also want to ask you is that 2024, or from last year really, has been a pretty global bull run for the markets, right? Are you expecting this to continue into next year? Because after November, we go into December, which is usually a very quiet month, with most investors taking profits off the table.
Well, we didn't expect 24 to be this good, you know, but then out of left field came the AI bubble. It came the fact that the consumer is stronger than we thought. And all in all, 2024 has resisted a lot of bad news. You know, we've had pretty bad news, I think, out of the two war zones. We've also had the bad news of the fact that everybody was expecting interest rates to fall. And they haven't fallen. They've pretty well stayed where they were, except for one move. So I think the market's taken quite a lot of hits this year. That's not to say the same as it will do the same next year. You know, we're really, I think, in a period of real uncertainty. We don't know who the president's going to be. We don't know what their policies are going to be. We don't know what the consumer's going to do. We don't know if interest rates are going to go down or where inflation is going to go. You know, it is a real area of uncertainty at the moment. And all I think investors can do in that position is focus on what you're doing at the moment. If you're reasonably keen on equities, stay there. Don't make any big decisions because you're probably going to be wrong. In fact, I would guess that, from today, happy Diwali. It's probably time to take some time off until the inauguration in January.
All right. Thank you so much, Richard, for speaking with us and joining us on this conversation this morning.